G'day, money miners. We're in God's country. Jeez, I don't know what to do without the headphones. We're lapelled up, and the bloody first one, and who else would we get for the first interview? Someone from Terra Capital. The main man himself, DK Dylan Kelly. Mate, welcome to our humble abode.
Swanky outfit, I like.
Isn't it? Bloody beautiful, mate. Just 20 metres from Stabbo's, right where we need to be.
Stabbo's.
Oh, love it.
One of the few people to come on for a second time now.
Yeah, I know. Now, DK, everyone that doesn't know DK, which you've probably been living under a rock if that's the case, you did the Rare Earth Spectacular for us back in the day. Yeah. Now, you appear to be not just a rare earth expert, but you would have transferred your energy to somewhere else during the time that rare earths have sort of, NdPrs fell off the cliff a bit. Where has your energy gone in the last 9 months or so, DK?
Where has my energy gone? Good question. I think it's certainly fallen down a cliff in terms of trying to find value in a space where there's very hard to find. That, if we look at things like uranium, obviously that's gone particularly well, but that fell off a cliff starting January.
But yous were in that when we first spoke to Langers. Like yous got in that pretty early compared to people like me that have hopped on the bandwagon late.
Well, I mean, you got to go back to that concept of, like, if you're not a contrarian, you're a victim. So you're always dumpster diving into commodities that are under a hell of a lot of pressure and trying to figure out when's the time to sort of venture back in. So things like uranium are probably going through a bit of a blowout phase at the moment. What's commodities that are under significant pressure and sort of hitting cyclical bottoms is where we're trying to spend most of our time. So you think of things like platinum, that's going through a hell of a lot of pain at the moment. Like, is it sexy? No, everyone hates it, but that's the time to start actually doing the work. So when you start seeing operations be parked up, shouldered, prices hitting all-time lows and balance sheets getting blown out, and supply incrementally closing, well, that's where the fun is, and that's where the action is.
Palladium even more off a cliff.
Exactly right.
Very much so.
Yeah, interesting interplay there between the different elements and how they all come out in terms of that byproduct, co-product spread.
Yeah, right. Boys, DK, we've got a bit of a run sheet for today.
Yeah,
but we could venture off the path at any point.
We're known to do so.
That will happen with Matty lined up every day.
I reckon a good place to start from the notes you'd kind of sent through, DK, is gold, and slightly different point compared to the PGMs in that the commodity itself is starting to come into a bit of a bull market. Could be in a bull market already, but that hasn't totally been reflected in the valuation of gold miners, gold developers and explorers. And that's been a sort of contentious point, a lot of debate around it, people throwing up these charts comparing valuations from 20, 30 years ago to today. So I reckon let's just start from the basics and how you're seeing the valuations in the gold space at the moment versus the underlying metal price.
Good point. So take a step back. So we're global long only. So when we look at the market, we're comparing, say, North American dominated majors and mid-tiers, ASX, and to a smaller or lesser degree what's happening, what's UK listed. And if you look back at the performance of, say, ASX versus North America, you've got a very divergent set of performances in terms of the underlying strength of the fundamentals of those businesses. So you compare the balance sheets and the cash flows of the North American names. It's one of these great dumpster fires of torching shareholder capital.
How long's that been the case for?
So there's one really useful report that's published about every quarter. I think it's called Metals Focus out of the UK. That does it on the top 15 globally, and it does some really interesting metrics around things like total share count over, say, like a 20-year cycle, in which case you've seen that increase like I think it's like 4.5 times in the space since the top of the last cycle. So you've got the situation where North American markets have gone from bad to worse in terms of capital allocation, growth for growth's sake, dumb M&A, not necessarily generating that much cash flow, but essentially operating very much on a whim. You compare that to Australia, where we've actually got a large number of different names that have actually generated a hell of a lot of shareholder value over a long period of time, and it's been consolidated at relatively solid premiums relative to the last closes. I think that's probably comes from a different sort of mindset to how we think about it versus how we think about other locations. With that backdrop, though, it's a case right now saying North American markets extremely beaten up, and for good reason. Investors too scared to touch it. You can buy explorers on less than, say, $5 an ounce US, which is pretty damn low. I think if you look at that on, say, like a 20-year horizon, that effectively just one linear chart down. But yeah, it's complex and it's nuanced. You have to sort of understand the different moving parts that sits behind that. Well, let's face it, like we all talk about all-in sustaining costs, and we know that's complete crap. And you guys did some great work on, an all-in was it corporate cost?
All-in cost,
Cake.
Cake.
Thanks, Johnny Mac.
Johnny Mac.
Like exactly the way to think about it. And in the case of the North American majors, it's all effectively the same, but even worse so. But there's some that are far worse than others. Like, say, if you look at, say, Agnico, which is actually quite a sexy business in terms of like amazing assets.
They've done better than the pack as well. Like
so much better.
Yeah,
like
they've actually maintained low costs and and expanded production at the same time. It's really impressive.
Grade is king.
Yeah.
Their grades I've seen some of the grades pretty phenomenal. Like the amount of ounces they put out, which helps in an all-in sustaining cost.
Exactly.
Per ounce.
And the jurisdictions they're prepared to go to, like we're talking like frozen Arctic, like far beyond Northwest Territories in Canada, like places where you need effectively like icebreakers to actually bring supplies into site. Like they're in those sorts of locations. And those guys have generated a hell of a lot in the way of returns. But if you look at, say, the likes of, say, Barrick, Barrick's got this very, very terrible sort of concept of capitalising a lot of the inflation that we've seen over the last, like, say, let's call it 5 years, where they've got growth capex sitting on top, something in the order of like $300 an ounce on a consistent basis. That's just eating away margins completely. And this is a business that's actually ex-growth. It's actually been declining on a consolidated basis. So,
but they brag about replenishing reserves. There you go. You need the growth capex to do that.
Exactly right. Well, if you compare this to the top of last cycle in that metals focus analysis, it was I think it was an average reserve life was something like 18 years. It's now down to about 14 years across those 15 majors. So it's fallen even though we've seen growth or acquisitions. So they're barely washing their face and spending a lot of capital on things that arguably don't necessarily add that much value.
If only they were successful in buying First Quantum, and their corporate costs, their all-in costs would have just fallen through the floor.
Exactly right.
You don't get the copper byproduct credit if Cobre Panama is offline.
Your copper output would have fallen through the floor as well.
So you're seeing value in the effectively the developer explorer space on the North American markets. Is that fair?
Correct. And I think that's probably where we're spending a lot of our time at the moment, simply just due to the fact that, you can see some value. It's hated at the moment. And, well, let's face it, if we just look at what we can see in terms of the earnings uplift we're going to get over the next couple of quarters. So we've never seen such the move we saw in March in terms of dollars per ounce uplift in whatever currency your costs are denominated in. It's extreme. And no matter how bad the cost inflation is at any part of the world, you're never going to see that sort of margin erosion in that place. And when we start getting the likes of, say Fast Money or some of the quant funds in the world, when they start doing mark-to-market upgrades for how much cash these businesses are going to be earning, I think we have to see some type of flow funds here that's going to uplift the whole sector. We haven't seen that yet. So GDX, GDXJ, a lot of the other ETFs have actually seen negative flows, I think, year to date. And we're only just starting to see that sort of tread water as a flat number now. But we're all watching that very closely to understand exactly how that flow of funds is going to impact and flow through to the majors and the mid-tiers.
I think the North American gold, and I've probably repeating myself a bit here, but I was just speaking to someone the other week about Red Lake, and it sort of confirmed what the thesis is that the culture in North America is a lot of these residential areas that they don't want to mine the mine too quickly because they want to. There's generations of families that work in these mines, and they don't want to. We've seen Evolution, Northern Star, and the like go over to North America, and Northern Star are just making it work at Pogo. Evolution have not made Red Lake work. Is that a factor in identifying? Yeah, that it's a out of flavour area for gold, but is it ever going to properly be in flavour without getting that? I guess that high-speed Australian culture over there that we see over here, very different. Do you take that into account?
If you think, I think back historically through different cycles and where we've seen that sort of momentum trade moving offshore, we don't necessarily have the deposits here locally. We have to look further afield, and what typically drives that is high commodity prices, cash buffers that can effectively enable that sort of position. It's not necessarily that strategic in terms of doing some proper greenfields exploration, developing some deposits in some weird jurisdictions, and then developing them with time using their existing strategies. In my mind, what we're just seeing is frothy M&A. We can't find anything that at home that's worth value, bugger it. We think we can apply our same logic here, or say the Murchisons in WA, and thinking that, this is going to apply in the far-flung north of Alaska, or certain parts of like Ontario. Like, the logic there is just too far a bow to be drawn, and management teams thinking that you can instill your culture over such vast distances in your practices, I think it's just farcical, to be honest.
Yeah, but what's the solution? How do you get the value over there?
Well, Matthew, you get Cadrell over there. That's how you fix the culture. You get Rhino Sullivan over there to crack the bloody whip. That's how you do it, Hobbsy. Isn't it?
You've seen this before.
I have. Well, Trav, how do you reckon North America how do you think the industry would react to a bit of a Rhino Sullivan and Cadrell injection?
They would increase productivity.
It's funny that you say that, Trav. I'll show you exactly what it's probably going to look like.
Show me.
Asked Reebok to send us Terry Tate, some people thought we were crazy. But I'm a firm believer in paradigm breaking, outside the box thinking.
Hey, buddy.
It was over 15 minutes ago, Mitch!
And since Terry's been with us, our productivity has gone up 46%. We're getting more from our employees than ever before.
Right?
You know you need a cover sheet on your TPS reports, Richard! That ain't new, baby! Hey, Janice!
That is what you see there. Let's just change that NFL jumper with some Cadrell high vis and Rhino Sullivan just going around toweling up people that aren't adhering to the productivity standards. That is going to get any industry to where it needs to be.
I agree, mate.
Well, I kind of think about this from the mindset of like, who runs the business? Is it like, if we've got like a BHP style sort of heavily bureaucratic organisation where every function and every sort of process that the business has is through one sort of structure or cube that's rolled out periodically. Yeah, you can do that and you can push that in any part of the globe. But really this is about people and management. And if you've got amazing management teams that, or people that run these businesses that are enabled, not necessarily through bureaucracy or process, to make decisions on the ground as they see fit and enable them to effectively run their own show without the oversight of people in, say, West Perth. I think that, in my mind, is like your starting point in terms of being able to do that successfully over time, just through people.
Yeah, because BHP, you wouldn't be able to apply BHP model to, or maybe the best gold mine in the world, but just because all those systems, processes and bureaucracy comes with a high cost base. Correct. It's all good in iron ore because it's heavily automated and shitloads of capital's been sunk, but it's tough to apply it to gold, I think. So.
Correct. Well, I mean, we always think about the concept of like BHP style ore bodies versus what, say, a junior is going to approach or attack. You need something of sufficient size, grade, scale that no matter how badly you fuck it up, you're still going to make money.
Yeah, well, you just can't fuck it up.
you just can't fuck it up. Whereas we start talking about sort of second tier, third tier gold assets, narrow, smaller scale, very much grade dependent. You need a completely different set of skills in order to be able to perform that role to a high degree in order to ensure some sort of cash flow.
I've got a bit of a left field question on the goldies for you, DK. It comes from commentary out of Agnico. They were talking about there's three places, the three best places in the world to have a gold land holding is like Nevada, and Barrick and Newmont have done well to consolidate that. B, the at a buy where Agnico are. Am I saying that right? It's one of those words I read, but I don't know how to pronounce. But anyway.
We know what you're saying,
yeah,
right?
That's all that matters. And see Western Australia, but no one's done a good job of consolidating that. Do you think like WA is an area kind of ripe for consolidation, and who's a natural consolidator? Or is it just too hard because the parties are just like so disparate and have all these different influencing factors?
Is that like saying like what Barrick and Newmont have done at Nevada, like actually turned WA into
Goldfields? Yeah.
I mean, let's face it. Like, there's just been simple M&A over the past 10 years that have just made a hell of a lot of sense. Like KCGM. Yeah. Let's bring the two together. 50-50, equal shares, doesn't work for anybody. If you think about Goldstrike and the consolidation there between Newmont and Barrick, makes a lot of sense. You had effectively, in some instances, the ore body effectively, the lease stopping at one point where stoping was coming up against, and effectively that's just leading straight into Newmont's territory over the other side of the line. Like, just the stupidity of running these operations the way that they did to bring it together makes a lot of sense. But look, let's face it, with any of these things, it's all about the personalities and the people that run these operations and the ability and the egos involved in being able to make sensible decisions to bring it together. I mean, I think we're starting to see that now, but are we at that time in the cycle where consolidation is taking place? Well, gold price has just made a hell of a move. I don't think this is the time where we typically see that. If anything, it sounds like this is where we start seeing people start to pay overs for assets, not necessarily consolidate.
We need Bondi back, like not your Bondi, his grandfather, because the super pit was him consolidating all the things around there. Imagine if that same sort of consolidation got applied to the WA side.
Yeah. You don't want to be paying 30% premium every time though. You want to do merger. Yeah. Otherwise, you just shoot yourself in the foot.
Merger of equals is the way.
Yeah.
Well, I mean, if you look back at, did you guys ever have a look at Gold Nerds? It's that website that is the
spreadsheet.
Like really nice spreadsheet there that just sort of locks up, all this data on all the different producers and how many ounces they've got and where the producers are. I mean, I always look at that as a count in terms of just that number of producers on that list and how that fluctuates over time. And the number of producers is actually quite significant. Last time I checked, it was something north of 60. Now, just on the ASX, I mean, that's a heavily fragmented market, and God knows how many of them are actually generating any cash, but it's few and far between. If consolidation's ripe in any particular sector that fragmented, maybe not at this time in the cycle, but you'd have to say at some point that's got to come back a fair bit.
So you made the point about large capital flows, and there's two different buckets. You've got the index funds, the GDXJ, GDX, and then you've got quant funds who are fundamental based in their trading. What do you think the tipping point is? Obviously, you said sort of change in earnings cycle and that being appreciated by these algorithmic quant funds. But in terms of the index flows, why do you think we've seen outflows in a year? Traditionally, when the commodity price goes up, it attracts new interest. People sort of start tipping in money. I think uranium's a great example of that, like you said before. Why have we not seen the same thing happen with gold so far?
Yeah, it's a good question. Look, so if you go back to beta, so what the index is doing versus what the commodity's doing, it's sitting for most of those functions, it's probably north of 0.8, 0.9. So pretty highly correlated. But I think price correlation and fund flow is different. Yeah. And there's a whole range of different variables that go into it that I honestly don't understand. And I've tried to sort of pick it apart. But fundamentally, it does tend to flow on a sort of backwards looking basis. So you don't get that fund flow immediately in terms of the price correlation, but you get it on a trailing 3 to 6 9 months. That flow of funds eventually happens.
Yeah. Okay.
So that's how I'm sort of thinking about it. So today we haven't seen it, but we're only, say, 6 weeks post-March, or the March rally, and it's going to take a long time for, or probably the June quarter results to come out, where we start to see the talk relative to the commodity price in earnings start to filter through.
My favourite word.
Yeah, you guys love talking. It's. I can't believe I used it. I should have used something different.
I wonder who's running the West Gold Twitter account. There was a talk comment about us sitting at a table last night. Bet you I know who.
So that kind of leads me to think about the role of central banks in the push in the gold price we've seen, because a lot people have been making a big deal of central banks, positive and substantially positive, buying of gold over the past, I think off the top of my head, it was 17 months. They wouldn't be interested in buying equity in gold miners. They want gold for the reasons you buy gold, so...
Mate, we'll buy royalty companies, like happy days. Like, you don't have to worry about the stupid costs.
I'm not sure about the mandate of a central bank. But, does that play a role in your thinking at all into how, flows might not come to ASX miners, TSX miners?
Look, good question. In my mind, I've always struggled with all these different macro factors that impact gold market in general. Like the fact that fundamentals don't apply. We don't talk about costs. We don't talk about market balance or anything like that. It's all sort of muddled because of the size of the inventories, visible inventories that exist around the world. In my mind, central bank buying is obviously critical, and I think it's really interesting to see. I'm not too sure if you guys have seen the chart, but it effectively shows CB buying effectively immediately post Ukraine invasion. And what we saw there was just a really interesting factor where people suddenly figured out, hang on a second, if we can suddenly have our US denominated bonds taken away from us overnight, perhaps all of our liquidity buffers and capital buffers aren't necessarily what we think they are. What are we going to do? Therefore we buy gold. So in my mind, I think that was an interesting kind of pickup in terms of that thematic. And to see that acceleration in certain economies that have, let's call it, say, particularly acute exposure to US denominated debt and could actually be subject to sanctions, did seem to see an acceleration in what their central bank holdings were.
Copper's the next one that you mentioned that we should chat about, and I'm super keen to get into this because of the intricacies. And we had a conversation that was released last week when we're posting this one on tin, and it was broken down to us how the distinct differences in the tin market between concentrates and metal. And I want to sort of have this conversation in regards to copper, because we've seen a huge change in the treatment of refining charges. They've gone from the benchmark at about $80 negative. And then we've seen on the back of that, kind of textbookly that the metal price has started to rise, and that relationship isn't always, crystal clear. But what have you sort of been seeing in the copper market with your ear to the ground here? Okay,
so the way that I think about it is, if we look at what's happened in terms of supply, so what's coming out in terms of the build out that we've seen in smelters over the last 18 months, and how that build out is effectively flowing on and impacting TCRCs. So in my mind, I think Tech in their annual sort of commodity outlook did a really good job of this, of explaining the different markets that are coming on. So we've seen a significant amount of new capacity come out in certain parts of China that was effectively going to be quite environmentally friendly forms of scrap relative to what they used to have, which is effectively throwing huge amounts of scrap into big furnaces and burning off huge amounts of all the plastics and different materials that come around with that sort of primary scrap. Now, because of green China and beautiful China policies, it's really hard to be able to do that without sort of central authorities getting pissed off with the amount of externalities that you produce in doing that. So we've seen a huge amount of new capacity come online that's a bit greener, a bit cleaner. But obviously that needs new capacity. In that same time frame, we're seeing about, let's call it an 8% growth in concentrate, or the concentrate market in terms of supply that can handle it. But we're only seeing around about 0.7, 0.8 times growth in actual concentrate supply. And a big chunk of that supply growth over the last 5 years has been Panama. So I don't think that's necessarily helped the situation in terms of shifts in that market. At the same time, we're also seeing a large number of concentrate producers start to build their own smelting capacity. So Indonesia's forced Freeport to build a big smelter in Indo, and that's effectively running late. So it was going to be, second quarter this year. It's probably going to be sort of early next year at this point in time. Things like that have big interplay. So take a big step back. What's happening? We've got a huge amount of overcapacity build out in terms of smelters, not enough supply coming online. They're all bidding for less and less tons of concentrate. There isn't enough, therefore prices are going flat, if not negative. So that in itself probably talks more to the primary source of supply. So primary concentrate being, let's call it, keep it simple, 75% of the market, 25% coming through scrap and SXEW, or going from or chipping away from that concentrate into SXEW. So that cathode market effectively growing very, very slowly over the last couple of years. Let's call it 1.5%, maybe 1.3% compounding. You look at demand sitting somewhere closer to about 1.7, 1.8. That demand imbalance has effectively been just about eking each other out. The only thing that sort of throws a bit of a spanner in the works is where we start seeing annual disruption. So that tends to be about, 1.2 million tonnes a year in terms of labour supply, or union problems in parts of Latin America. Issues with geopolitics, availability of supply. There's a whole bunch of different factors. Last year it was pretty small. I think it was only like 700,000 tonnes in terms of annual supply disruption. That was pretty weak. There's a lot of union agreements to be sold up this year, so there's a lot of focus on that potentially having a repeat of what we saw in the last cycle of those rounds from 4 years ago. So I think there's an interesting interplay there. For me, what we're focusing on is less so about that supply dynamic around mine supply and more around scrap, because we can't necessarily see where the next ton of copper is going to be coming from in a constrained primary supply market. So the fun thing that you can always look up is the correlation between the copper price and mentions of copper theft. And that's one market that I kind of encourage people to look at, because if you look at that in the past, every time you hear about someone in a tin pot republic effectively just going in and cutting, several kilometres worth of copper cords or wiring, and effectively just throwing it on the back of the truck, hoofing it off and selling it for scrap supply. Now that's a real feature. Transnet in South Africa was losing something in the order of like 15% of its effectively electrified train line on a weekly basis.
It's one of those power outages in South Africa.
What they say? So who was telling us South Africa? They just chuck a bloody coat hanger over the power line, run it to their house, and that's their power. Well, that's how they draw power. Well, they reckon she's just a free for all. I think like electrical cable drums as well on. Probably the same place where that smelter's getting built in Indonesia. They go missing pretty regularly with the locals as well. They strip it and sell it.
They sure do. Now, if you look at, I'll send you guys the chart, but it's quite interesting. If you look back at previous cycles where copper's gone for a run, the reports of copper theft also goes vertical as well. But this time around, we're only seeing very, very small amounts of that mention. Now, if you think about where the next pound of copper is going to be coming from, I'm very focused on that and where that's going to in China and what you see there on a monthly basis rolling forward. So at the moment, that doesn't necessarily look like it's going to be able to alleviate much of the tightness that we're seeing right now. But you would assume that if China was actually going to be supplementing, say, concentrate feed with secondary scrap, that they would be able to sort of increase that volume, but we haven't seen it yet. The other factor is, can they actually do it? If they do it, it's heavily polluting for the most part, and will Beijing give them, or will central authorities give them the ability to crank that out, pollute, just to effectively keep them open?
So why is it Freeport that's building the smelter, or?
Correct.
Yeah. So what do you think at the moment, building a smelter when you've got negative treatment charges, is it? It's obviously part of a long-term thing, or they have to build it?
Just the same with nickel. The government's forced them to do the downstream in country.
Sorry, we've just got to cut to some breaking news that's just come out in the paper today, boys. Check this out. The WA government is forcing all FIFO operations to use Brooks Airways.
Wow.
Yeah, we've seen, I know we've talked about it before, but look, this has been coming for a while. I think the bill's been sitting in the Senate for a while and just awaiting signature. But
everyone realised Qantas is just a scam, and
and I think obviously
cheapskates.
everyone's finally just listened to us, and it's the logical path that Brooks Airways takes over this role. So Hobbsy, mate, when you get your first FIFO gig after I place you for a fee, mate, do not take the job if they aren't using Brooks Airways. So pretty much if you want Hobbsy to work for you, the future of the mining industry, probably the future of the finance industry after that, make sure Brooks Airways is running your charter flights. Otherwise, he's not working for you.
Yeah. And you're breaking the law.
Yeah, well, it's law now. So
I am not getting on a plane.
If you don't use Brooks Airways, you will be fined. Yeah, by the government. Sanctioned and possibly the mine shut down. So do the right thing, mining companies. Get Brooks Airways and stay out of the courts.
But it's not just happening there. It's happening. So that's a localized issue. It's happening in China in terms of investment in new capacity to actually be a little bit more environmentally friendly. But there's also a huge amount that's being built in North America as well. So the US actually has several of these plants coming online, and depending upon who you look at, there's potential upside here that green sort of recycled copper could go from 25% of the mix, depending upon who you look at, to 35 to 40% over the next 10 years. So that could be a key source of incremental tons.
The IRA budget as well, paying for it.
Yeah.
To an extent.
Free bonus.
So where do you look for relative value in the copper space? Are you looking at established producers who've got a great ability to ramp production, or are you're looking at the developers who actually have something substantial? What's the most attractive part of the copper market at the moment?
So I think our default with a lot of these things is if you take a look back at raw materials as a sector, the market broadly is very much underweight, in the order of magnitude of say just over 300 bips. Average allocations sitting somewhere in the order of 30% underweight across several different sort of fund managers categories. So when the sector returns, you tend to see flow of funds effectively trickling through to the largest cap or the large cap quality names first and foremost. So where's the liquidity at? If I want copper, we're going to see that effectively hit through from Freeport and then trickle down to the universe from there. So we tend to see more value in particularly names that have strong balance sheets, relatively low costs, effectively all the key quality metrics that you'd want to see with an existing producer in a relatively stable jurisdiction. In our mind, it's effectively a checklist of quality. Sometimes we'll be looking to add in certain jurisdictions where we've got some genuine sort of tier one exploration potential. You guys have spoken a little bit about what's going on in Vicuña in the past, but we think what's happening in that part of the world is really interesting. So we really like the likes of, say, NGEX and to a certain degree Philo as well, and how that effectively plays out over the next 5 years.
NGEX, is that's part of the Lundin mine? Yeah, London, part of that group. Yeah.
It's one. I mean, they've had the best buddy drill hits of recent time. They've added serious scale to their discovery, haven't they?
Correct. Serious scale, massive tons, extremely high grades, and we're only very early on into the discovery phase. So let's face it, the easiest way to find a porphyry is to start with one. And these guys have been looking there for several decades. If there's a time to sort of be involved in backing explorers, these are the sort of names and these are the sort of giants that we like to look at.
How do you treat those explorers, but when they're found a porphyry and they just make the porphyry even bigger porphyry, where does it sort of, do you start dropping off how much value you're getting from that addition to the resource? Because we know it's big, needs a shitload of capex.
Yeah, good question. Okay, so the way I think about it is there was a guy at WASM, Pietro Guj, he wrote an article about probability of exploration success. And so we got all the world's data on number of holes and number of discoveries. And he came up with this probability weight that if you are if you're going to find through greenfields exploration a world-class size deposit, your probability of hitting it was 0.04%. or something like that. If it was going to be an economic discovery, it sort of came up a little bit higher to like 0.09. If it was on an existing mine site, it was like 20%. So that sort of probability sort of gives us a way to think about how these things play out. Now, if you look back at, say, BHP did this amazing sort of public talk in 2008 that talked about exploration, discovery, and porphyries, and how the bigger the footprint, the bigger the deposit that sits within that. And I think that's sort of given us a bit of an interesting way to think about how porphyry plays play out. So you can typically find maps that sort of outline the mineralization halo that sits at surface, and you can see for the likes of, say, like an Escondida or a Las Bambas, they've got enormous fingerprints, but quite often there's several deposits that sit within that 5 kilometre grouping rule that sort of light up as being interesting. So you'd find another skarn, another epithermal, say like a copper or a moly deposit or porphyry within that camp. That sort of vectoring sort of helps us think about where a company is in terms of its, exploration timeline. So in the likes of Vicuña, they've been there for 20 odd years now, effectively looking for these big deposits. They've found it. They know they're in the right region. If you were to compare that to, say, Alkane with Boda, they're only like 2 years or 3 years into that process of, hey, we found one. Okay, big system. Where do we start? It's going to take a long time. Maybe we should be thinking about that in, say, like a 3 to 5 year basis before we start thinking about where they find grade and where they actually find something that's economic to develop. So it's just a very long-winded one about way of how we think about it.
There's a bit goes into it. I think we've established, yeah.
So we've spoken gold, we've spoken copper. Let's talk about silver.
Oh, they all come together, Trav.
Yeah, I know.
Yeah.
Not quite the like Olympic ring, it's bronze instead of copper, but I mean, it feels like the same thing. Yeah.
Yeah, if you're not gold, you're last.
Yeah. So what do you make of the like silver often kind of, I don't know, trails a gold run in some ways. There's like a speculative move down and people who are attached to this gold silver ratio. And of course it's got some industrial purposes as well, which drive demand, but I can't for the life of me figure out how to actually like model a supply demand model for silver, like other than just like, people's historic ratio expectations or something. How do you think of, silver's recent rally, a little bit of euphoria in that scene, and also the companies who might have a silver endowment?
Yeah. So silver's hard, and the reason why it makes it hard is simply because we've got large amounts of non-visible inventory. So what are we talking about there? Vaults, bullion. So how big is that holding and where does it sit? So fun fact, if you go visit a vault or some type of storage depot, and they do exist in some very strange locations in this country, you will see bars of the stuff just hanging around, sitting on the shelf almost everywhere. In places like Switzerland, there's always been this sort of notion that the bulk of the world's mine silver sits in big vaults there. Exactly how that comes to the market. Under the mountains in some sort of like dark sort of cave somewhere. So that influences it. For me, I always try to bring it back to supply demand and where it costs. So if you think about the market right now, we're talking about just over 1 billion ounces were produced last year. Around 25% of that came from primary silver mines. 50% of it came effectively from byproducts of lead, zinc, copper, gold. And if you look at the top 30 mines in the world, the largest being, say, like a KGHM, which is the Polish outfit that has that JV with South 32 in the copper sphere. They've got one mine in Poland that produced 40 million ounces, but it's like a very distant sort of byproduct of copper, gold in that process. So if you think about that list in terms of who are the major producers, they're effectively all owned by companies that are not pure play silver companies. If anything, if you go to the top 30 deposits, only 5 of them are owned by companies that actually have the word silver in their name. Now that's important because if you look at all the different silver codes that exist in the world, there's not too many of them that actually produce that much silver and have got bugger all exposure to it. Yeah. So it's an interesting sort of interplay in that place. So what we're talking about here is very small portion of the supply market is actually focused on pure silver and is sensitive to the price of it. Second thing that I think about is costs. Those pure play silver miners, costs over the last 5 years have exploded. They've gone from something close to about $7 an ounce all in to something closer to 19, according to 2023. So they've gone up a hell of a lot. Grades have declined. There's been fewer new producers coming online, and effectively, there's been limited investment in places like key producers like Mexico, which has recently started to ban open cut mining in certain provinces. So a lot of issues there. But fundamentally, we're always got to be thinking about where exactly is the new sources of supply coming from. And there's just not that much in the way of large greenfield lead, zinc, copper deposits with big byproduct credits coming from silver.
Is there any other uses for silver, like in comparison to gold, like besides store of wealth?
Yeah. So
silver nitrate rings a bell.
So like back in the day, used to be all about photography. So last year, the world's had this sort of weird market. So supply's been effectively flat at just over 1 billion ounces a year. Demand has been sitting at about 1.5, 1.2%, and that's going back for quite a while. Now, there's big changes in that demand segmentation, but effectively you've had photography fall off a cliff over the last decade and a half. What's picked it up is PV cells or solar cells have come up massively. They're now sort of like the number 2 factor in terms of industrial consumers behind electronics. Sorry, no, I got that wrong. It's one of the two, but it's now number 2. And if you look at the rate of growth that silver's had, it's almost been like an exponential run. Like in 2004, when PV cells started at like mass build-outs, like the intensity of use there was quite high, but that's gone from something like 50 million ounces a year to closer to, I think it's like 250, 300 million ounces as of last year. So huge rates of growth, but the intensity of use in cells has actually declined massively. So the World Silver Survey puts out this amazing resource. Highly recommend anyone looking to jump it out, just grab the PDF, and it goes through all these data tables and shows you how this runs off. But the PV cells have effectively plummeted in terms of their consumption. They've been able to thrift it, use alternatives, and effectively that sort of rundown has gone from something like 200 grams per kilowatt, I think it is, to something closer to 70 in the space of 14 years. So it's a huge sort of run, but it's still the second biggest driver of demand overall.
Plenty of people say that it's essentially an industrial metal now. You shouldn't purely view it as a precious metal. The industrial demand is so high. And I remember Brian Lax, who we spoke with a couple of weeks ago, also saying that the silver miners, at least the ones he looks at, trade at a premium. So he's encouraging Adriatic Metals to change their name to Adriatic Silver for the next leg of growth in the stock. Yeah. So the other topic we wanted to chat about was capex blowouts, what causes them, what doesn't cause them, and what are the big misconceptions about capex blowouts at companies. We're talking about, perhaps management quality, market cap of the company, commodity, scale of the project, actual size of the DFS, capex, and these sorts of things. So I'm not sure where you want to start this one, but you suggested looking at what does not cause capex blowouts. So should we go about it that way?
Yeah. Actually, let's take it one step backwards. So if you think about spectacular fuck-ups in projects, I think it goes in this order by sector. Olympic Games, guaranteed to come out like 4 to 5x. US defence weapon systems programs, probably a number 2. And then I'm going to say mining, oil and gas projects come in at a very distant second, if not third in that list. And here's the problem though. This seems to happen with a great degree of cyclicality and regularity over time. And if you look at the academic data and literature that's been written on this stuff, you seem to go through cycle upon cycle where things go wrong and they suddenly go out and study it and figure it out and try to understand what's happened. That gets forgotten. And then another cycle emerges and we repeat the same patterns and problems of the past.
The defence projects make sense because they get priced on cost plus. So it's in your interest to blow out the cost massively. A mining company is shooting themselves in the foot when they blow out capex. So why is it, so often forgotten cycle to cycle? with miners?
So the way that which I've sort of come to this understanding is if you look at academics that have taken a view on this, or private credit or debt funds that specialize in this space, they've looked across, say, several decades and have got all the key data on different project metrics, like everything you can find about a feasibility study and the data that goes into the analysis behind. Where did the blowouts occur in the structure of, or the timeline, and what went wrong? And the most amazing thing is all those key things that we sort of psychologically think have a habit of being the problem, in fact, actually have no bearing on having a correlation between a capital blowout and the reasons why. So if we think about things like, funny jurisdiction. So if you're going to build a project in Timbuktu, like an obscure commodity, you think, that's going to blow out or that's going to have a problem. You think about the size of the business, the size of the project. Mega projects are guaranteed to blow out. But if we look at, say, the last couple of years, where have the real big problems occurred? If we think about, say, Tech Resources and QB2, that was originally $5 billion US. They're going to produce 300,000 tonnes a year. That's now sitting closer to 8, and we're still about 12 months away from that sort of blowout. If we think about, say, Cosmos, that was a business, that was a project that had, let's call it, low teens IRR, some aggressive assumptions around capex. Why did that blow out and then suddenly get shelved? Why did Iron Bridge just decide to suddenly have a massive series of issues and blow out? So what it all boils down to is one of two things. All the things that you think are actually driving the problems and not the real issues. And I'd highly encourage you guys to have a look at the video of this from this bloke at PDAC 10 years ago that did this real comprehensive study on it. And there's a matrix that he puts up there. The two key things that actually drive a blowout is, number one, market heat. What does I mean by that? We all know what it means in terms of conceptually what's going on in WA over the last 5 years. There's been a lot of construction activity. There's been a lack of available resources, and we've seen a huge amount of competition for labour. The market is effectively being tight, and it's being very hard to put people on the tools, and essentially that lack of available resources to enable the building and construction development of a project means that timelines get blown out, costs come in higher and consistently run higher. So that was like the first sort of big sort of aha moment for me. How do you measure that? Well, it's kind of hard, right? Like there's not necessarily a barometer that says the market's tight. We sort of know it is conceptually. Like if you suddenly get Facebook requests from recruiters asking you to see if you want to come be an operator on a site, over the last couple of years, that's sort of been like a key sort of signal to me that things are going wrong. Right now, we know the bottom of a cycle. Whenever I used to drive from Perth down to, say, Busselton, for 100 Ks, every strip mall on the side, there would be HSV Maloo utes and jet skis and bikes being sold. And that was a clear signal we're at the market bottom as everyone started flipping their toys. So we've all got these sort of measures and metrics to think about how tight the market or the cycle is. In that case, we've got to think about it how it's been over the last few years. The second one that I think is really kind of interesting is this notion that how marginal the project is. And that's fascinating because if you have, the crux of it comes down to if you've got a project that whose sort of economics are pretty weak in terms of an IRR, capex to NPV ratios, you're essentially having a project that the managing director or the project study manager is effectively having to massage and lower that capex number. So what do? They effectively start optimizing it. They cut it back. They think of ways that they can actually strip costs out to make that capex number lower. And as a result, what happens when they try to build it, all those factors that they've effectively tried to throw out effectively come back to them, and we end up getting the price end up blowing up quite spectacularly as a result.
But if you didn't do that, it didn't get built because you needed to juice it in order to get the finance. You need the debt, you need the equity, and they have to believe that the returns are going to be good. But
correct. So all those factors just sort of come into play. So So the matrix that I think I'm hoping you guys can put up on the screen, but effectively if it's top of the market in terms of market heat, so commodity price running very high, lots of projects being built, and the project is marginal, so effectively 15% IRRs or less, are using aggressive commodity price assumptions to actually get there, and every time you see an optimization term or well, there's a couple of red flags that go along with it, but essentially those two things you've got to be very, very alert to. And funnily enough, only one of those categories is something that a management team can actually control. So yeah, that's just how I've sort of come to think about things.
So what's the, how do you trade on it?
How do you trade? So in my mind, what you're looking for is guys that are trying to build projects. I think as a general rule, you're tending to avoid, for the most part, when the capital structure of any business heading into a build is always going to be fraught with risk, whether it be delivery timelines, permitting, execution risk. Like, it's too numerous to actually count off just why you should actually have a need to be there.
Yeah, so, and because you're long only, you got no interest going the other way.
The sun curve, mate. Avoid the trough. Like,
but how do you? I suppose how do you weigh up all that sort of stuff? Does that's a lot more overweight than the potential for a buyout?
Correct. So the way that we think about it is what a company says the capex is going to be versus what it ultimately does, which we've got pretty comprehensive data sets going back as long as we can think. On that, it's typically in the order of like 30 to 40%. Now, every feasibility study includes a spider diagram showing sensitivity to capex blowouts. So in my mind, how we do it is that's always part of the modeling. If that spider diagram shows a particularly aggressive inflexibility towards capex, I think you have to sort of like take a step back and say, do you really need to be there? Like, you flip it on the other side, like what are the major projects that have occurred over the last few years that have actually had no problems at all? So if you think about Adriatic and their project, you had like triple-digit IRRs. You had effectively you'd think that the amount of capital they've put into there has actually got more than enough buffers to overcome any potential risks or any potential problems in that. There's been a couple others there that we could probably delve into, but in my mind, yeah, you start thinking about those characteristics. If you've got really strong, healthy returns, and they're not necessarily based on super aggressive price assumptions or factors that are effectively outside of their control, you'd say they've actually got a high probability of actually pulling this off. So I think, yeah, backing really good projects is always a better way to be sort of looking at through that lens, rather than saying we'll take a marginal project that's sort of at the end of its sort of tether in terms of could effectively be blown out.
So it sounds like it just builds in a margin of safety into your investment, because there are some, lower returns ones that have been built on time and on budget. Capricorn's Colour Window comes to mind. That wasn't stellar, but the guys did it on budget and they've generated decent returns given the, a 0.9 gram per tonne ore body. But it sounds like it also reinforces contrarian thinking. It's also telling you to avoid sectors that are running really hot, say lithium over the past couple of years, jumping into a new project that's being built, perhaps like a core lithium or something. This would have reinforced your thinking of, say, hey, I need to be more contrarian than that. This commodity is running hot, this market's running hot, there's a good chance the thing will be over budget. Is that sort of how you think about it as well?
We do, and we tend to overlay that with, say, like a regional assessment about market heat. So if we were to take, say, what's happening in WA, yeah, it's been a really hard market over the last couple of years, labour availability, a lot of construction, but we haven't seen that sort of heat occur in parts of, say, West Africa, where guys, majors to juniors, have actually gone out and built, conventional plants in relatively rapid times with little to no problems or little issues. So I think you've got to take a sort of a granular approach to the jurisdiction and understand what are the variables involved in effectively, that market heat function, and see whether or not, the EPCM contractors actually have people available to actually do the work. Whether or not you can actually get people on the tools without actually having to fly them in from far-flung jurisdictions to get it happening. So you're taking detailed assessments on the ground as to exactly what those sort of metrics are.
Very good, mate.
Brilliant, mate.
Bloody sense. So
been-
we better let you get back to the 2 meetings you had to push back. We're like getting you going. But mate, thanks for popping our Sydney cherry for us, DK. That was
My pleasure, guys.
sensational, mate.
Yeah.
Sorry for waffling that.
No, it was
No,
awesome.
we want the waffle.
Yeah.
Awesome.
We want the waffle.
Any wise words to leave the money miners with?
Yeah,
DK?
what do you got, DK?
Nah, I'm tapped out.
Good stuff. Thanks
There's
for coming on,
always
mate.
plenty of shit that I never knew I'd know after talking to you. Copper theft, boys.
There we go.
Cheers, Copper.
Hooroo.
Righto, DK. What an absolute gentleman. Great to have him in the flesh there, the big fella. Love the Terra boys. And, mate,
You know so much.
oh, and just like, mate, as we always said, Terra Capital, one of the early supporters of us in our journey, and we are indebted to them forever. Very, very bloody good blokes.
Good on you.
So, right, thanks all the partners. As always, we got VRIFY, we got GetWet, we got, who do we have in the show? We had
K-Drill.
K-Drill.
Brooks
Righto,
Airways.
Sullivan. Break was over 15 minutes ago, bitch. I think he said Mitch, actually.
No, you Janet.
We had bloody DSI, Silverstone, CRE Insurance, and WA Waterboards. Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.